We're now going to move into what is the backbone of everything that we have talked about so far and will talk about going forward, and that is what I like to refer to as the King indicators. They are a couple key overall concepts more so that need to be paid very closely attended to, or else everything else kind of falls apart all around it. So they really are the linchpin. I'm not trying to get over dramatic or anything, but they are critical. Have I mentioned critical to making sure that we're placing ourselves in the best possible location in order to have success with any of the strategies that we use. And as you know, there are all sorts of strategies out there. So how do we choose which one should we apply? Should we choose that one or this one? What about the strike prices? There's a bunch of those too. Well, we need to be focused on probabilities. But with that being said, probabilities need to be of quality information. Sure, we have our core component, probabilities. We want to know what is the probable outcome of something happening. I mean, you do that all the time in life. If I'm crossing the street, what do I need to do? What do I need to be looking for to have a probable outcome that I don't get hit by a semi-truck? Same thing with options. It all revolves around probabilities, and probabilities are only as good as the quality of the numbers. Quality numbers, what are you talking about? Well, we're going to get into that in the world of engineering, which I am a engineer by degree, no longer practicing, but it was a huge concept, a huge, heck, there's even engineers that can specialize in quality control, meaning you gotta monitor, you gotta make sure that nothing is spinning out of control. You want it to be of quality. So quality control is what we're gonna focus on, and this is, the indicators, the King indicators are going to help us with. Again, we can easily screw up the probabilities, and as I've already noted, probabilities being they're at the core of things probably is something we don't want to screw up. So we got to make sure that we're going through the right steps, looking at the right things, and understanding, what we're looking at in order to ensure that we keep it good, clean, quality data. I was thinking, how can I really summarize? How can I, just really convey the fact of how everything flows together and how, one thing can really screw up everything else. And then I thought, you know what? I like triangles. Triangles can do a great job of summarizing things. So here we are. I came up with, that's a pretty bad looking triangle, but you get the idea, the pyramid of quality control. So like any good pyramid, it's only as good as its base, and then you work your way upward. So down at the base of the pyramid of quality control, we have liquidity of the underlying asset. So that is where it all starts, the liquidity of the underlying asset. And the reason that is important is because options pricing is most efficient, accurate, when markets are highly liquid, or in other words, have lots of volume. Again, we need liquidity because in order for the options pricing formula to be, and we're not going to get into the formula, so there's not going to be any mathematics, but just understand the concept. We want efficiency. We want as much accuracy as we can get, and we're going to get that accuracy, that efficiency, when we have markets with high volume in the underlying asset. So that works our way up to the options pricing formula. Now, why do we care about the options pricing formula actually being efficient, trying to be accurate? Well, IV, implied volatility, comes from the option pricing system. So again, working your way back down, if this is non-liquid, well, what is that going to do to us? That's going to hinder the options pricing formula, right? And because the options pricing formula is hindered, what's that going to do to our implied volatility data, since that comes from option pricing? Well, it's going to hinder this. And now we look what's at the top of the pyramid is probability. And implied volatility is the driving force, the key component, however you want to look at that, of the probability calculation. So again, if implied volatility is hindered, what's that now going to do to our probability data? That's also going to be hindered. That's also going to be corrupted. So it's all about the liquidity. Now, it's all about other things too, but as I'll repeat multiple times, if you do not pay attention to liquidity, then all this other stuff from above, it's all ruined. It's all ruined. It doesn't really matter. I mean, you could have the best possible strategy, you could have the best possible strike prices, but they're actually not the best because you never paid attention to the liquidity, which needed to be kept a close eye on. So just real quick, and you can do this more on your own, but we already journeyed through we really kind of did a dual one, but journey through the pyramid with these two different scenarios. Like I said, liquid, we understand. All right, so if it's liquid, then that means our pricing formula is going to be efficient. Perfect. If our pricing formula is efficient, then that's going to give us a good IV value. And because IV because IV contributes to probability, that's going to give us a good solid probability. What about non-liquid? Well, if it's non-liquid, that's going to be an non-efficient and inaccurate market. So non-efficient and inaccurate, what's that going to do to our implied volatility? Well, that's probably not going to be very good either, since that's coming from our pricing formula. So what happens when we have a not so good implied volatility? Well, now our probability is not going to be too good either, because IV is that driving force. So if you don't start and make sure things are liquid, then you're pretty much screwing up the rest of the pyramid. Now, I'm assuming you kind of already figured out what those two key components are, but let's just make sure, and I don't want to assume anything. So we need to make sure that we understand the two king indicators. The first one is liquidity. I've beat this dead horse already, but I'm going to continue to beat it, because literally this whole course, it won't, it's not going to matter, because if you screw up the base of the pyramid, then everything else above that, including, of course, that probability information, is going to be corrupted. And if we have corrupted data, we're going to have corrupted strategies, and we're going to have not so good results. So you need to make sure that the liquidity is there. Quality control pyramid. If you screw it up at the base, it just, nothing else going forward really matters. And then, of course, implied volatility. Is implied volatility high? Is it low? Is it normal? And knowing this is going to be the key to unlocking the probability numbers. So implied volatility, we have to know, is it high? Is it low? Is it normal? And this is going to be, that unlocks everything else. But remember that pyramid, implied volatility, sure, that's the key that unlocks everything. But if it's already been corrupted because we haven't addressed liquidity, well, then it's not really unlocking anything other than, corrupted data. But the one thing I do want to note, do you notice how direction of stock is not listed as a king indicator? Hopefully you're saying, well, that is kind of shocking, but I'm not too surprised, because thinking back to the blowfish effect, that direction of the price, especially in that Apple example, it really went in that person's favor, yet they still lost money. And then, thinking about on all those other charts you looked at, how implied volatility just dropped, therefore the price dropped. So yeah, hopefully that is making sense, or is not shocking to you that the direction of the stock is not listed as one of the indicators. Now, does it play a role? Absolutely. But at the same time, again, going back to that blowfish effect, because implied volatility can have such a dramatic effect on the overall options premium pricing, it's something where, should it be considered? Absolutely. But would I consider it one of the king indicators? I would not. We're going to first start with liquidity, and then in part two, we'll talk about the implied volatility. So liquidity is just simply how efficient a market is. That's really it, how efficient. In particular, how efficient the options market for a specific ticker symbol is. So that's what we're caring about, efficiency of the options market. So why does this matter? Well, let's look at a basketball trading example. So let's say that you trade basketball cards. Which do you think would be easier to predict the probability of? Trying to trade a card of Billy Bob, or trying to trade, a card of, let's say, Michael Jordan or LeBron James? If you had these two cards and you were thinking about getting into the market, which market for these do you think, would really be easier to trade the card and, have good predictable probabilities? Now, keep in mind, I'm not Billy Bob. Go under the assumption he's not some, famous person or anything like that. He's just some unknown person. So unknown person trying to trade that card versus, Michael Jordan or LeBron James. What market do you think is going to be a little bit easier to participate in? So sorry, Billy Bob, not many people have heard of you, and therefore not many people are going to be interested in trading you. Or in other words, there's not going to be much volume in your market because people just aren't interested. Who is Billy Bob? If volume is low in any market, so whether we're talking options market, basketball trading card market, then choices and flexibility available significantly decline. I'm not proclaiming like I'm coming onto any groundbreaking topics. I hope this is all review, but nonetheless, I want to cover it just to make sure. So The lower the interest, the lower the volume in any market, choices and flexibility are also going to decline. And as option traders, the more efficient a market is, the more flexibility we are given, and we need room to move around. We need room to maneuver and implement our strategies. So we got to have volume. A market needs to be efficient. And what else? Think back to that pyramid. What else does an efficient market do for us? Oh yeah, that's right. It influences the options pricing formula. And what does the options pricing formula influence? Oh yeah, implied volatility. And what does implied volatility influence? Oh yeah, that's right. Probability data. So it all starts with that efficient market. We got to make sure that we're not getting ourselves in a Billy Bob market. We want to be in a LeBron James, a Michael Jordan type trading environment. So how can we tell if a market for a particular ticker symbol is efficient? Hey, that's a good question. And I should note that if you are able to pull off this maneuver at your computer, that means you are super flexible and you're probably going to be doing very well. So that's the goal, metaphorically speaking, is we want to be able to be that flexible, be able to enter trades in with our toes if need be. And in order to get that flexible, we need what? Say it with me, efficiency. One of the key variables out there for options, maybe you've heard of it, maybe not, is called open interest. And open interest is simply just the number of contracts that exist for a specific ticker symbol at a strike price. So is interest for Michael Jordan or LeBron James cards high or low? I'd say that's pretty high. Therefore, you would expect the open interest value to be on the high side also, right? Because there's a lot of interest. And I think the best way to look at this, and I'm not trying to overly complicate things, let's go the opposite direction. Let's just really lower it, is look at it like this. Replace open with low or high. So see you later, open. We're gonna get rid of you. And let's apply that to the Billy Bob and Michael Jordan markets. Billy Bob, yeah, nobody's ever heard of that guy, so that's gonna be a low. Nobody's ever heard of somebody, low. So low interest. All right, yeah, that makes pretty good sense, I would hope. What about Michael Jordan? Well, I think a lot of people have heard of him. Hey, what about LeBron James? Well, I think a lot of people have heard of him, so let's replace open with high. There's going to be high interest in that market, right? So that's the way I look at it. I think that's pretty straightforward. Just eliminate that word open, and the rest is going to tell you kind of what it is. There's either low interest or high interest. So what is considered high? As a general guideline for options, I'd say at least 300. General guideline. As I've said before, and as I will continue to say, personal preference, personal risk tolerance, paper trading, figure out what you feel most comfortable with. I'll say 300 as a starting ground, but if you think that's too low, fine. If you think that's a little bit too aggressive, fine. Figure out what you feel most comfortable with. So taking a look over here at this actual options chain, would you replace open? So what are we going to replace this with? High or low? And why would you say that? Hopefully you're saying, wow, that there seems to be quite a bit of interest. I mean, you look down here, look at this. In the thousands, we got some Michael Jordan, some LeBron James markets over here. Now ask yourself this, where does the market seem to kind of lose interest? Where does efficiency tend to drop off? So if you want a second to pause and take a look, I'll do that. But where does the market, like I said, seem to lose interest? Okay, if you pause, welcome back. Check out up here. Look at this. All of a sudden, the market really drops off. So you get around these strike prices of, 119, 18, 17, 16, and so forth. Yeah, the market drops off. I would consider this, there's not much. This is definitely low interest up here. Then all of a sudden right here, it hops back to, obviously all the high interest areas. But there's no doubt about it, up at that point, definitely low interest. Overall, though, would you say this is a liquid options market? Hopefully you're saying, yeah, this looks pretty liquid. I would agree. The open interest here is high. High interest means there's a lot of efficiency to it. There's a lot of liquidity, and that's what we want. Let's take a look at another example here. So same question. When you're looking at this market, would you replace, because remember we want to take out the open. Now are we going to replace open with high or low? So why? Hopefully you're saying, well, this I would say is pretty low for the most part. Why are you saying for the most part? Well, you can see right here actually a whole ton of interest. So right there, you could say, well, it's got high interest there, but then when you go in this direction, wow, things drop off. Go in that direction, wow, things drop off very quickly. So perhaps you can make it work, but I think once we get to our next liquidity, variable, you're going to notice, never mind. But where do you think, or I should say, where does the market lose interest for this one? Well, pretty much right off the get-go. I kind of already answered that, but here, okay, decent here, okay, 430 decent, and then drops off, and then before you know it, you're already at zero, where there's literally no interest. And then, same thing here, it drops off very quickly. So do you think it's an open, or do you think it's, the open interest on this one has led to a liquid market? Like I said, I suppose you could say, well, here, yeah, but outside of that, at the other strike prices, not so much. I would call this a non-liquid environment. Now, I'm certainly not going to say you shouldn't use open interest at all, but a very kind of quick, a very, for those of you back in school, maybe you remember I'm not saying I'm guilty of this, but maybe you didn't quite read the book or whatever. So you're like, what, I better pick up some Cliff Notes so I can quickly read for it before the quiz on Monday or whatever. So what is a Cliff Notes version of the story of liquidity? Just check out the spread. The bid-ask spread is going to give you a very good idea, a very quick idea of how liquid is the market. And the best way, if you want to, a little tip to, just make the process that much quicker and efficient, is look at the money strikes. How is that spread? So let's compare the two. And these are the same screenshots we've been looking at. So the first one, which according to the open interest, we've said, all right, this is a liquid market. Well, let's look at the spread. So right here we have a spread of 2 cents, $1.65 by $1.67. 2 cents. All right, I'd say that's pretty tight. Go a little bit further in the other direction. All right, 2.15 by 2.17. All right, 2 cents, not bad. The other direction, $1.22 by $1.24. All right, not bad. So just without looking, if we did this, all right, I'm going to just block out this. Just looking at the spreads, well, like I said, that's why I'd always say check out open interest. But right off the get-go, okay, this has got to be a pretty efficient market if the spread is only 2 cents. Now, on the flip side, let's knock out that too. Well, here we have, and this is the one, actually, I probably shouldn't have done that because I do want to show the correlation here. So this is the one that pertains to the 21,000 open interest. But now you look at the spread, 15 cents by 21 cents. That's a big spread, especially if you would look at the percentages of it. But you look up here, this one's only 2 cents, but this one's got that much more, and it's even that the premiums are that much cheaper. So 6 cent spread, you go up just one. So remember up here we went up just one strike price, and it was still 2 cents. You go up one here, and that's what, if my math is correct, that's 35 cents. Now you go up one in the other direction, 5 cents. So without even looking at open interest, you're just looking at the spread. All right, this is probably not the most efficient market. And again, if we were to take this stuff and then start to apply strategies to it, are we going to get that good of implied volatility data? And if the implied volatility data is and it goes up to our probability, then there too. So base of the pyramid, this would not be a good base at all to start with for the base of the pyramid. Up here, yeah, sure, this would be a nice solid base to the pyramid, and that's something you can work with. Perhaps you're looking at your watch and thinking, wow, this is supposed to be an advanced course, and all this guy is doing is sitting here talking about liquidity and volume. Yeah, I get it. Well, it's one of those things where it seems obvious, and especially when somebody's talking about it, you're like, well, yeah, duh, you want things that people are interested in. You want Michael Jordan, not Billy Bob. Yeah, people stumble over it time and time again, myself included. So I don't know how to really summarize it, but it's almost kind of like a little sneaky ninja because it kind of hides in plain sight. Maybe that's the best way to put it. But so that's why I wanted to spend time on it, because I wanted to make sure that a basic concept is actually basic and that we're all on the same side with it. For us retail traders, and I am assuming that we don't have any hedge fund traders that are watching this. So for us, quote unquote normal folk, The one great thing about the options market, it is very liquid in the sense of I want to sell and you can sell, unlike, let's say, penny stocks, for example. However, this is not why we just reviewed liquidity. Why did we just review it? Well, hopefully you're like, oh, here comes the dead horse again. Time to beat it. Yep, time to beat that dead horse. We got to think back to that quality control pyramid. This is not a matter of liquidity in terms of can I sell like it would be in penny stocks. We can sell, sure, but we got to make sure that we're getting good data. We got to be quality control engineers. And in order to get quality IV numbers, we need quality liquidity. So we need to stay focused on that liquidity, and that's going to keep us allowed, or that's going to allow us to focus on quality and work our way up that pyramid. So that's going to wrap up part number 1 here. In part 2, we're going to start to move, or continue, I should say, move ourselves up that quality control pyramid. I'll see you back for